Perhaps one of the hardest things to do on the planet correctly or well is to raise your kids. There are entire cultures whose parents have completely failed and the entire culture is hurting from it. So I've done some research on looking for the one thing, like what's the one thing that helps everything else in raising your child, or at least one of the main things, right? Because there's probably only a few of them. And it's the same type of thinking I use when I think of the stock market. Like where's the maximum point of leverage, right? If you get the one thing right, you get, 95% of everything else right? So in investing, it's know the direction. Know the direction of the price, because if you can figure that out, then you've pretty much won the war. But with raising a kid, and the reason I'm bringing up raising a kid is because it's extremely complicated to properly and appropriately and do a really good job raising a kid. Well, I did some research, and it turns out that one of the main things, other than being, keeping an open heart and being empathetic and sympathetic to your kids and first checking in with yourself before you comment on something they're doing, is to have dinner with them. 20 minutes for dinner, that's it, 4 times a week. It doesn't even have to be dinner. It could be breakfast, but have 4 meals with your kids a week, sitting down. Can be at home. It doesn't have to be. That's it. And if you have 4 meals with your kids and each meal is 20 minutes each week, then the probability of them turning out well and having good high scores and being able to communicate and connect with other kids and have empathy and sympathy with other people and have a thriving life is exponentially higher than kids who never had dinner meals with their parents. So pretty interesting, huh? It's that one thing. So I want to talk about the one thing that the market's having to do to figure out which direction to go, because there's kind of one thing that it has to do, and that is the content, the theme of this weekend's podcast. Hey everybody, this is RC Peck, and this is my weekend podcast, and the theme for this weekend's podcast is retest. And I just love this stock photo of these 3 people about 3 inches apart from each other. One guy's looking to see how blue the color of the water is. So there's a retest coming up, and it's pretty much baked into the cake that the S&P is going to retest its August lows. If you look at the screen, you can see that there was a low in August, a very short 4 or 5 weeks ago. And that low almost stopped exactly with where the October low stopped back in October of 2014. So with Janet Yellen coming out and saying, we'll keep rates the same for now, that was a big reversal last week. And the markets then moved down. So look, I don't know what's going to happen in the future, but when I look at this price chart and I see the 200-day moving average now clearly moving down, and I see this bottom in August bouncing off the exact same bottom in October, and Janet Yellen not being able to help. And you think her not raising interest rates would be a good thing. Like, hey, that's great. It makes stocks more desirable. But in fact, it just creates uncertainty out there. And so even the market getting 0 interest rates did not help it, which means there are a lot of sellers when we're coming up to this point here. And that means I think we're going to retest this August low. It's almost a shoo-in. Of course, I don't have a crystal ball, but with how the market's looking and with all the central banks in unison around the world doing their best to print lots of money to keep people's desires to have more stocks high, it's not really doing much. People really are kind of saying, maybe I shouldn't be in the market. I've been in 6 years, or the market's been up over 200% over 6 years. I'm going to take a break. And in fact, as people are aging in all the countries around the world, they are moving more and more of their money out of the stock market as they have to cash out and as they are getting more conservative in their investing, even though, or is it even though, interest rates are ridiculously and painfully low, the older investors over 70, the things they're buying are the bigger and bigger and bigger companies. Well, it just so happens there's an index that measures the really, really big companies, the Dow Jones Industrial Average, and that's doing even worse than the overall market. So that's a very huge group of people, of 78 million Americans in the U.S., and almost all of them, I'm sure, have some level of investment. So the market's having a hard time finding out why it should go higher, and so it's not, and it's moving lower, and I think we're going to retest the August lows. So what's the takeaway? What do we do? Sometimes you don't do anything, right? Sometimes you just have to wait and see what to do. And there is deep research on the more complex your system is, the more money you will lose. And the more trading and the more activity and the more interaction you have with your investment strategy, the more money you will lose. So the takeaway is a really simple idea. And it's really just to follow your stops, which means follow your stop losses, which means follow your system, which means you probably should have a system, which probably means the system you should have, if you don't, spends the majority of its effort on managing its downside. Because if you ever were to speak to any of the, say, 100 best investors on the planet, they'd probably all tell you, and most of them have when they've been interviewed, they put about 10 times more effort and energy into managing their losses than managing their gains. So as the market goes through this uncertain time, manage your losses, mind your losses, and taking a loss over a short term is much better for your future than sucking it up and taking the big loss. If you don't know what to do, if you're scared, and if you're scared to sell, one of the principles that I follow myself personally and that I teach to my members and my coaching clients is attempt to never be 100% right or wrong, which means then never sell 100% of your position, or never buy 100% of your position at once, and never sell 100% of your position at once, right? So you could sell a third of it and wait a week, and then if things are worse, sell another third and wait a week or wait a month. But in this way, you're eliminating more and more of your amygdala in the conversation, and your amygdala is the part of the brain that manages your emotions, and your prefrontal lobes are never going to win the battle against your amygdala. So follow your stops, because this is a time period, 6 years in an uptrend the market has been, that this is a period where we really need to follow stops. Hey guys, this is just another step in helping you safely accelerate your future and your portfolio. Until next time, this is RC Peck. Hey guys, I'm kind of excited to tell you that I have a new training coming out this coming week. So look out for it. It's called the Diversification Myth Training, and it pulls back the curtain on the industrial investment complex, the big box advisors, the conventional and independent advisors, and the newsletter industry, and shows you how what they're doing, the myths they are inculcating on us, is hurting our wealth, is hurting your wealth. And I did a deep dive into this training. It's super meaty. So I don't know which part of it you're going to like the best, how it's super clear on what works or what doesn't work, or just the amount of data and how I've clearly presented it to you that you're going to like. But whichever one it is, you'll know when you see it. So guys, have a great weekend and look out for those emails about the diversification myth. All right, you guys take care.